Good morning, it's Jeffrey Christian of CPM Group. It's 10 o'clock on Tuesday, the 25th of October here in New York. I want to talk today about investor hedging and profiting with options, something we've talked about earlier in the year and it warrants coming back. Last Friday, I showed a chart of a hedge that we had priced on February 1st, and I said that we would be talking about this soon. I had wanted to focus on something else in Friday's video, but today's the day. I want to talk about investors hedging and profiting with options. The concept is that investors can stay long their physical gold or other gold assets and protect themselves against lower prices by hedging their long positions with options. They also can profit from their hedge instead of losing value when the price falls. I want to talk about what could have been done. I'm going to focus on that hedge that we showed you in a video on February 1st. And central to this, you have to remember, central to our practice and to options investing in general, you don't wait until expiry. If the price moves to the point where it makes sense to either sell or modify your options positions before the expiration date, do that. And in fact, it doesn't make sense to wait until expiration necessarily because you have issues related with time decay. I'll show you another example, one that we did priced on February 24th, just before the Russians invaded Ukraine. It was a shorter term, event-driven hedge. The price of gold had spiked up to $19.75 at that point. And then I'll talk a little bit about what can be done now. Now, it's not just investors. Effectively managed mining companies also would hedge. Emphasis on the word would. They have a fiduciary responsibility, the management of mining companies, to protect their shareholders' value against volatile price moves. But most of them abrogate that fiduciary responsibility these days for a variety of reasons. It's interesting because processors, smelters, refiners, fabricators of precious metals products all hedge or should hedge. Most of them do. And financial intermediaries hedge, or most of them do. Let's see if we can do this. Now, we've talked about this before, really since the early 1980s. I co-authored a paper called Effective Commodity Price Risk Management with a chief economist at the World Bank in the late 1990s. The World Bank said that CPM Group's method of hedging commodity price risk was probably the most efficient and effective strategy in existence at the time, and it probably still is. This year, we've done 3 videos on it. In the middle of January, we did one, Hedging for Investors. We followed that with a follow-up, Hedging for Investors 2, Staying Long, also known as Investors Profits with Options. And then we did one called Effective Hedging for Producers and Others on March 4th. Here are the links to them. They're still available on YouTube, and they're very educational. Now, my 2 examples today, one is that February 1st, the price was $1,801, and it had been bumping along either side of $1,800 for about 6 to 8 months. And then the second one was February 24th, when the price had spiked up to $1,975 in anticipation of an imminent Russian invasion of Ukraine, which occurred 4 days later. The price, you can see, obviously went higher. So if you were long gold, physical gold, over the course of February, it went from $1,800 to $2,070. You did very well. But then as you look forward, you can see the price fell and fell and fell and fell, so that the price is down around $1,650 as we're speaking to you today. So let's look at that first hedge, which was on February 1st. And we showed you this video, this chart, in our February 1st video, and I showed it to you again last Friday. You could have, the price was $1,801 on February 1st. You could have bought a $1,650 floor, a put, paid for it with a call spread. And what you'd find is your hedge, your physical metal or your underlying investment would benefit from rising prices. If the price fell, your hedge, that put, would become more valuable. And it didn't even have to fall to 1650 to become profitable. Price, in fact, fell below 1650, but that's almost beside the point, especially since the price fell below 1650 after this October hedge would have expired. This was a futures option, so it would have expired in the last week of September when the price had not quite fallen to 1650. Right? So you would have been able to benefit from the lower prices on your put. The hedge was at the market from 1650 up to about 1900. And then over $1,900, you would have a risk of that contingent premium. The cost of doing this, of putting this hedge in place, was zero. The investor could then have sold that position if he wanted to. So let's see what happened to the price. By July 21st, we picked a couple dates actually out of our records where we're saying, okay, the price is very low. If you had done that 1650 hedge, you might have sold the put back for a profit. Price then bounced back up to $1,800, but it came back down. And around August 22nd, it was on its way back down. It was actually around 1738 when we priced another let's sell the put. You can just leave the calls out there because they're probably going to expire worthless. But you could sell that put back. So what happened? February 1st, $1,801 spot price. The floor price of $1,650. Just buying a put would have cost you $29.30. But because we like to pay wholesale, we pay for that put with a compound spread and we get zero. So you put no money up. You have to put up margin, 15 or 20% typically for a lot of investors, but you're not spending that money. You're just depositing it with your broker against that contingent premium should the price be more than $1,900 at the end of September. But you paid nothing for that hedge. Now, July 21st comes along, price is now down to 1730. Actually fell below 1700, got down to like 1690 or so. And the nearby active contract was 1730. The October was 1721. Selling that put would have generated a premium of $22 an ounce. So $2,200 per contract. If you had managed to pick the intraday low, which was 1686, it would have been $32 an ounce. So somebody looked at my slide last week and said, well, the thing would have expired worthless before the price fell below 1650. Right, but you don't wait until expiration. July 21st, the price has fallen down. It's $100 less than where you had bought it. And you can earn $2,200 on a total investment of zero. You can't calculate the percentage increase on that because you have zero as your denominator. But you could have earned $22 an ounce on your hedge while staying long. Price bounced back up to about $1,800, and then it started coming back down. Around 1738, in the middle of August, the 22nd of August, we said, hey, we've got time decay going on here. This thing has just a little over a month left before it expires, but I could still sell it for $7.35. It's not as good as $22 that I could have gotten a month ago, but hey, it's $7 profits on an investment of zero. Not too bad. Of course, if you thought the price was going to $10,000, you wouldn't have put this in place. Now, my second example, the drums of war were beating on February 24th, and this is a shorter term event-driven hedge. This was priced on February 24th, 4 days before the Russians invaded, and the price was $1,975. You could get $1,875 put, pay for it with a call spread that kicked in over $2,000 at expiration, and gave you most of the upside even if the price did rise over $2,000. $2,075 actually is what it was. You'd give up $50 of anything over $2,075 at the end of March, right? Very short term, event driven. Hey, the prices just spiked up over the course of February from 1,800 to 1975. The Russians are on the border of the Ukraine. I think this is a pretty good place to lock in some profits. I actually didn't calculate this. Again, zero premium. I actually didn't calculate the profits. But if you had bought this on February 24th and sold it back in late March, you would have done very handsomely because the price actually had fallen. First, it went from 1975 on that day. It came back down to about 1900. Then it went up to 2070 or so. And then it came back down to 1900. And at 1900, you would have had a very handsome profit built into that hedge. And you could have sold it back. You'd still be long your physical underlying asset, but you would have made a profit on your hedge. Those are some of the things that could have been done. Now, what might be done today? We have investors saying, hey, you know, the price is down to 1650, 1630. Should I sell my gold? And the answer is a resounding no. Yeah, look at the world around you. In fact, since we got that question on Friday, the world has gotten even more treacherous. Don't sell your gold. We've had other people who have said, well, yeah, but you know, the price is so low now, it doesn't make sense to hedge. Well, it always makes sense to hedge, especially if it doesn't cost you anything and you can keep most of the upside. So hedging done intelligently always makes sense. It's like wearing clothes. Yeah, you don't need so much clothes in the summer as you do in the winter, but clothes makes everybody around you happy. Yeah, so it always makes sense to hedge. Now, you might say, well, yeah, but I'm at the bottom and, you know, it can't possibly go any lower. And you have to say to yourself, isn't that what I said at 1800 and 1900? Maybe you're waiting for the world to collapse, the financial system to collapse, the Russians to invade Dallas, you know, and sorry, Dallas. Maybe you think the price is going to $10,000. Maybe you're wrong. Maybe you've been wrong for 10 years or 2 years or 40 years. Maybe it just makes sense to buy some insurance. So I'm not going to tell you what kind of strategy you can put on now. That's what we do for a fee. That's where we make our money. We advise investors and producers and smelters and refiners and fabricators and financial institutions on the buy side and the sell side how to manage their price exposure. And we do that. That's what we do. But hedging makes sense. And hedging is good as a life insurance policy. And it's also can be very profitable under the right circumstances. We often tell industrial companies that hire us to advise them on hedging, you don't look at hedging as a profit center. Sometimes it is a profit center, but you look at hedging as protecting your business from price volatility and from adverse price moves. Adverse price moves for a producer is falling prices, for a fabricator is rising prices, and for smelters and refiners, it's volatile moves either way because they're both buying metal and selling metal. That's basically what I wanted to talk about that today. I do want to say don't forget platinum group metals. Last Friday, we issued a market alert, and we talked about it in our video last Friday. call on the energy transition and platinum group metals, talking about the energy transition and headwinds that it will face, the likelihood that by 2050, the vast majority of our energy, more than half of our energy, will still come from petroleum and natural gas. And anything that's burning petroleum and natural products and natural gas is probably going to need platinum group metals to clean up its exhaust. So that market alert, it's available for $10 at our website. You can actually buy it on Amazon. If you are a Bloomberg subscriber, you can read the press release at CPM Group's Bloomberg page, which is NHCGR. If you're a Bloomberg subscriber and a client of CPM Group, you can actually download the report at Bloomberg. The report's free for CPM Group clients. Everybody else pays $10. We also last week released our Platinum Group Metals report to 2050. I stand corrected. We mentioned last week that we will be completing it probably within a week of today. So by November 1st, 2022, we expect to have this larger report. The last time we did this was in January, and it was about 80 pages long. We charged $9,500 US for it. It gives you price, supply, and demand projections to the year 2050 for platinum, palladium, and rhodium. It's available from CPM Group. You can write to us at info@cpmgroup.com. And we will take platinum or palladium as payment. You can go to our website. You can read about all kinds of stuff. There are free downloads. There are old videos. You can buy our reports. Gold, silver, platinum yearbooks, precious metals advisory monthly report, base metals advisory monthly report, and you can see what else we have about other markets. That's all I have for now. I'll talk to you on Friday. Everything being equal, my expectation is that I'll be talking about the next recession, what to expect. We will have seen our first flash estimate for the third quarter GDP come out on Thursday. So unless there's something more pressing, that's what I'm planning to talk about on Friday. Have a good day. Take care of yourself and those around you.